Cool. Again, today we'll deep dive into one of the complex discussion in FRM and CFA curriculum, that is value at risk. That is value at risk. See, if you just want to know what is value at risk at high level, it is easy to understand. And it was created only for the purpose that anyone can understand what is value at risk. Even who has zero understanding of finance can understand what is value at risk. But who are we? We are finance veterans. We are not only supposed to understand the value at risk, but also need to have like a deeper understanding of war calculation, war methodology, as in how we calculate war. What are the different methods to calculate war? Is it only one method to calculate war? What are the pros and cons if you calculate the war from one of the method, right? And that makes it difficult. And that's why you cannot understand, you cannot understand the calculation of war. You can see the screen. It says prerequisite. Everyone, you cannot, can you see the screen which says prerequisites? Okay, perfect. Because you cannot understand the calculation of war if you have not studied what it is written: standard deviation, normal distribution, portfolio management, option Greeks, fixed income. And we know we studied standard deviation and normal distribution in quantitative analysis session 1 and session 3. Portfolio management, all sessions are requisite. If you don't understand portfolio management, you cannot have a deeper understanding of the calculation of war and then delta gamma. Because one of the method in war to calculate the war is delta normal approach. Now, if you don't know what is delta, how would you calculate a delta normal approach war? You cannot. And same way, you need understanding of duration and convexity. Otherwise, you cannot do the proper calculation of war. So these are prerequisites. So please revise your notes for deeper understanding of war session. Okay. So, so these are some of the prerequisite topic that you should know before deep diving into war session. But the best part is we'll start from the basic level, zeroth level of the concept, and build the concept slowly. But again, after this session, revise our notes on QA, quantitative analysis, portfolio management, fixed income, and derivative. Okay. And that's why if you see your curriculum, war is given in which book? The last book of FRM. Because GARP expect, which book? Book 4. Because GARP expect that you must have completed reading for book 1, book 2, and book 3. That's why book 4. And in CFA curriculum, war is given in what? CFA level 2 portfolio management. Even not in risk management or quantitative analysis, in portfolio management. Okay. So therefore, these are the prerequisite discussions which are required. The best part is we have completed it, and today we'll start from the zeroth level. So in this session, what you need to understand? You need to understand why we need war. Most important. Why we need war? If we have a very good measure of risk, why we need war? What is the one of the best measure of risk that we studied in quantitative analysis session 1 and understood it in and out? Correct, standard deviation. Then why we need war? So first we'll try to understand why we need war. Then we'll try to understand the different approaches to war. High level, what are the two different approaches for war? One is parametric, another is non-parametric. Okay. Then in parametric and non-parametric, there are different methods to calculate war. That is analytical war, historical simulation method, And even in historical simulation method, it's not given in FRM part 1 or CFA level 1 or level 2. It is given in FRM part 2. There are two approaches. It's not written anywhere in book. There are two approaches. One is Dowd's approach. Another is Jorian's approach. Okay. Historical simulation method. Then we will try to understand Monte Carlo simulation method. And then MD. This is a very advanced discussion, very advanced discussion. It should not be even mentioned in FRM part 1, but in FRM part 2, they haven't mentioned about it in CFA curriculum, CFA level 1, level 2, level 3. They haven't mentioned about it, but it is one of the requisite discussion for any risk manager. So if you are going to model risk, you need to understand what is MD, multivariate density estimation, to calculate VAR. So we'll discuss about it. Then we'll discuss what is a spectral risk measure. And the last section is VAR a coherent risk measure? Is VAR a good measure like standard deviation? If standard deviation was there, why I need VAR? Is it a coherent risk measure? What is the meaning of coherent risk measure? The four properties of coherent risk measure. We'll discuss about those four characteristics and the properties of the coherent risk measure. And that is the agenda. Okay. So this is what we'll discuss today. Okay. And definitely we have our key takeaways. And what we'll do after completing this session, we'll try to understand whether we understood this or not. If we understood these 4 to 5 pointers, we understood the depth of these 4 to 5 pointers in and out, we are good. Okay. So clear what we'll discuss in war session 1. Awesome. Okay. So let's answer the first question. Why we need war? We have a very good measure, that is standard deviation, quantitative analysis session 1, where we discussed that why standard deviation is called as the measure of risk. Why it is called as measure of risk? Anyone? In one line, one word? Because it is able to quantify uncertainty. It is able to quantify uncertainty. And that's why the formula is summation of x minus x bar raised to the power 2 upon n minus 1, whatever, for sample. So the reason we use the reason we use standard deviation as a measure of risk, because we proved that it is one of the best measure to understand uncertainty in the data, or uncertainty in the return, or uncertainty wherever. But why we need VAR then? The reason is, if I say, for the time being, just forget quantitative analysis session 1. Just forget about it. Whatever you have studied in quantitative analysis session 1. And think that you are layman. You haven't studied finance ever. If I say I invest $100, if I say I invest $100 and the return would be 3%, to any layman, any naive person who has no understanding of finance, the return 3% makes sense to the person. It's okay, it's fine. 3% of 100 is what? $3. So I would earn $3 if I invest in a particular asset. That's fine. But what about risk 4%? I'm asking this question to you, that try to state this in your family who has no understanding of the financial concept or quantitative analysis. Will they be able to understand this number 4%? Say the risk in this investment is 4%. Will they be able to understand this risk of 4%? Or the question could be, I'm framing the question in a different way. Will their interpretation of risk 4% would be correct? What do they think? Just think. Go and talk to any family member and say the risk in this investment is 4%. What they will understand, what they will comprehend. Tell me. Yes, exactly. Exactly. They will say, oh, my losses are 4%. Exactly. What you all stated, that I'll lose 4%. But is that interpretation of risk that we studied, that we know as a finance veteran? Is it the interpretation of risk? Yes or no? No. We know that this is incorrect interpretation. But if you go and read any mutual fund and it say the standard deviation is 4%, most of your family member would say, oh, I would lose 4%. It's not loss of 4%. So the problem that I want to highlight is that everyone do not understand the true representation of risk. They don't understand what is standard deviation and what it is the measure of a risk. So to make a naive person understand, assume you want to discuss that investment. If you invest in this asset, the return for the firm to your CEO is 3% and the risk is going to be 4%. Then how would you make him feel that what the risk 4% is? You have to speak in the terms of losses. The most important point, you have to speak in the terms of losses when you're communicating your ideas about an investment to a naive person who doesn't know finance. Number one. The second is, the second problem is, if I just state a risk of 4%, what is the confidence? With what confidence you are saying the risk is 4%? Cool. Actually, it's not 96%. Behind the screen, you should think that I'm talking about risk standard deviation 4%. Whenever you say standard deviation 4%, it means you're assuming the asset is normally distributed and you're one standard deviation away from the mean. So when you say risk is 4%, at one standard deviation, what is the confidence level? Exactly. I'm not sure it's exactly 84% or not, but it is going to be 84, near about 84% approx. Yeah, that's correct. So therefore, that is an inbuilt assumption. That is a inbuilt assumption in the calculation. That one standard deviation away from the mean when you're saying risk is 4%. Because it means what? You're multiplying this 4% with one standard deviation, not 2.5 standard deviation or 1.96 standard deviation. It's an inbuilt assumption. Now you can say that I'm 84% confident that the risk would be 4%. Because risk is what? Standard deviation. So I'm 84% confident. But think, even to speak that, even you all, finance veteran, has to think a lot. You have to remember the assumption of normal distribution. You need to remember what is Z table. And you're thinking, when I say risk 4%, other person will understand it is 84%. The person who is naive is able to understand this is 84% confidence that I'm saying the standard deviation, the risk is 4%. That is a very absurd assumption. So what you need to have in a risk measure for a naive person, First was losses. The second is, so what is the persona that I'm trying to cater here? Persona, a person who doesn't know finance, and I'm trying to explain him the risk. So first I have to speak in the terms of losses, otherwise he will not understand. Uncertainty, summation of x minus x bar whole square upon n minus 1. This is what you will convey to the person. No. First speak in the terms of losses. Second, what is important? What we discussed. Second, what we need. What we're discussing right now. What is 84%? Correct. Confidence. How much I'm confident that this is going to be 4%. So you have to speak in the terms of probability. What is 84%? A probability? You can't say, I'm 100% confident that the loss would be 2 million. You can't say that, right? As a finance veteran, you cannot say that. Even your senior will not understand how you're saying the losses would be 2 million. Are you 100% confident? You have to speak in the terms of probability. So you have to speak in the terms of probability. That I'm 90% confident that the loss would be 2 million, or I'm 80% confident that the loss would be 2 million, or I'm 10% confident that the loss would be 2 million. You have to speak in the terms of probability. So your risk measure when you talk to a naive person who doesn't know finance, first is losses, second is probability. Third, what is the problem? Third problem in this is it doesn't state tenure explicitly. It doesn't. So you have to speak in the terms of tenure. That if I'm talking about the losses of 2 million, am I am I expecting it to happen in 1 year? Am I expecting to happen in 1 day? Am I expecting it to happen in 1 month? That is requisite. That is requisite. So the third is tenure. And the best part is war is stated with this. Losses, confidence, tenure. Clear? So war is created not for a finance veteran, but was created for naive people, for senior people, CEO, government officials, to make them understand what I want to state, as in what I want to quantify for risk. So therefore, you need a naive measure, that is war, for naive people. Is it clear? And because of that, anyone who is aware of Basel, anyone working in bank or ever worked in bank, so there are Basel norms. Without Basel norm, any bank cannot function. So there are certain rules and regulation that you have to follow. That rules and regulations are written in Basel Accord. There are 3 to 4 Basel Accord. Actually, earlier it was Basel 1, 2, and 3. Now we have 3.5. We'll discuss this in detail in the recorded lectures. That's fine. So when I'm saying Basel Accord, some authority, some officials would be writing those regulations. RBI is writing those regulations, right? So when they're writing those regulations, they most of the time do not follow standard deviation, they follow war because it is easy for senior people to understand what is risk here. Okay. So even do not think that war is like we discussed and it is a naive measure. Each and every regulation related to risk is written in war, not in standard deviation. Because senior people, government officials, prime ministers, everyone will understand risk in the terms of war. So let's see how the war is represented. So, war is written in the terms of losses, in the terms of confidence interval, as in confidence level, which is probability and time horizon. These three are the key ingredients to state a war. So how I will state a war? So this is a war that a risk manager will state. So he is stating that 1 year, 95% war is $5 million. He states that in 1 year, at a 95%, the losses is $5 million. But there are two interpretation of war. And now we'll understand the two interpretation of war. Clear? So this is how a war is being stated in your book, in your curriculum, in the Basel Accord, in all the government regulatory uh, document. This is how it would be stated. How you should interpret it. There are two interpretation of the same. There are two interpretation. The first interpretation is, I'm writing it, please write it down. First write 1 year, 95% war is $5 million. Interpretation number one is, I am 95% confident. It is necessary that you write. I'm 95% confident that the maximum loss in 1 year would be $5 million. This is interpretation number one. I'm speaking the probability. I'm 95% confidence, speaking the probability. Tenure, 1 year, and the losses would be $5 million. This is interpretation number one. Now, because you all know statistics, because you all know quantitative analysis, can you give me the second interpretation? Can you give me the second interpretation? I am. If I'm 95% confident that the maximum loss in 1 year is $5 million, then what about the rest 5%? Can you think about the rest 5%? If you're 95% confident that the maximum loss in a year is $5 million, then what you're thinking in your head about 5%, the remaining 5%, what you would be thinking? Here I'm 95% confident that the maximum loss in 1 year is going to be $5 million, but there is a 5% chance that the losses may exceed $5 million. So if I'm thinking in my head the losses may exceed $5 million, it means it definitely, I'm assuming it is a minimum loss. And if you're still not able to, I'm trying to develop the intuition. Mathematically, we'll see that and you will understand like this. But if I'm saying, first try to develop the intuition. If I'm saying I'm 95% confident that the maximum loss in 1 year is $5 million, then what about the rest? What are you thinking in the rest 5%? Oh, in the rest 5%, there is a possibility that the losses may exceed $5 million. So losses would be more than $5 million. So I am like 5% confident that the minimum loss in a 1 year is $5 million. So I'm also saying that there is a 5% chance that the losses will exceed $5 million. Is the two interpretation clear? Most of the people are aware of this interpretation with a half baked information. So they say, I'm 95% confident that they forget about maximum or minimum loss. They will say that in 1 year, the losses would be $5 million. That is wrong interpretation. And because we are finance veteran, we need to understand the nitties and gritties of interpretation also. Most of the people, if you go and even sit in the interviews, they will only talk about one of the interpretation, that I'm 95% confident that the losses in 1 year is $5 million. They forgot about saying the word maximum losses. Only people who studied CFA, FRM, or some MBA, good MBA colleges, from some good MBA colleges, have these two interpretation with them. Okay, it's clear? Interpretation clear? Both the interpretation written? Perfect. Now, in few minutes, we'll understand it in detail. That when I was saying 95% confidence and when I was saying 5% confidence, how it is a maximum loss and how it is a minimum loss. And you will understand like this. But wait before entering into that maths, because before maths, I have to tell you that what is the umbrella of the approaches in which your maths fall. So there are two approaches to calculate VAR. This is also important because if you study FRM, the problem is if you study the first chapter of VAR, they're talking about analytical VAR. Then in the next chapter, they're talking about delta normal approach, historical VAR. And then in the next chapter, they're talking about Monte Carlo simulation. So you will feel that the way they have written is not very structured. So I'm giving a structure based on the actual approaches of VAR, the way it should be written. So there are two approaches for VAR. One is the parametric approach. Another is non-parametric approach. Whenever you see the parametric, the word parametric, irrespective you are discussing VAR or anything on the planet, this parametric means we are assuming certain distribution. What are the distribution we have studied so far? Normal distribution, T distribution, chi-square distribution, F distribution, and binomial, Bernoulli, whatever. We studied numerous distribution. If you're assuming any one of the distribution, normal, T, chi-square, any distribution. Yeah, exactly. Exponential, beta. I don't know whether I taught gamma also not or not. So we studied so many distributions. Poisson distribution. So if you're assuming any distribution of your asset return, then it becomes parametric. If you're not assuming any distribution and you're just playing with the data itself, because data will have frequency, right? And based on those frequency, you're trying to calculate your VAR, not assuming any distribution, normal, T, chi, none of the distribution that you have studied, and just playing with the data and the frequency of the data, then that is a non-parametric approach. Okay? The only approach that you have to study, there are many approaches for VAR, but the only approach that you have to study in FRM Part 1, Part 2, or CFA curriculum is the analytical approach. The other name of analytical approach is delta normal approach. It's another name, not different approach. They are same, identical. Delta normal approach, analytical approach, delta normal approach. In both the approaches, actually one of the approach, this is one approach, only two name. They assume which distribution, as the name suggests, normal distribution. So what you're assuming that your asset is asset returns, not asset returns. Basically your P&L, your profit and loss, your gain and loss are normally distributed, not asset values. We studied, right? Asset value cannot be normally distributed. It is log normally distributed. We studied it multiple times. So asset return can only be normally distributed. That is what the assumption is. Now in the non-parametric approach, we are saying there is no assumption of distribution. So the first approach or the first method is historical simulation approach. If you really want my opinion, this is the only approach. Historical simulation approach is the only approach that is purely non-parametric approach. Is only that is purely non-parametric approach. I'm writing another approach that is Monte Carlo simulation approach. This also falls in the non-parametric approach, as in you're not assuming any distribution of asset return. That's true, that's fine. In the Monte Carlo simulation approach, you do not assume, this is a very important statement, so listen very carefully. You do not assume any distribution for asset return, but you assume distribution for risk factors. You do not assume any distribution for asset return, but you assume distribution for risk factors. And that's why I personally never believed that is Monte Carlo simulation is a pure non-parametric approach, because you have to assume distribution in Monte Carlo simulation. Otherwise, you cannot create or you cannot calculate VAR. You have to assume the distribution for your risk factor. So because they are not assuming as in they are not assuming any distribution for asset return only, that's why it is falling under non-parametric approach. So you can see this is semi non-parametric approach, but in any book, any curriculum, if you study, they will say it is a non-parametric approach. And when you study, when you read what is Monte Carlo simulation, they will say you have to assume a distribution in the Monte Carlo simulation for the risk factors. Contradictory statement, but that's what it is. Actually, MDE is not a approach. MDE is multivariate density estimation. Multivariate density estimation. If I say in a very simple word, it only means assume a distribution through the data. Assume a smooth distribution through the data. So you have to derive a smooth distribution through data. That is multivariate density estimation. We'll discuss about multivariate density estimation today, so don't have to worry about it. So parametric approach, non-parametric approach. In the parametric approach, you have what? Analytical VAR, delta normal approach. What it assume? Normal distribution. Then we have non-parametric approach. The first is what? Historical simulation approach, which is the purest form of non-parametric approach. Then comes what? Monte Carlo simulation, and then multivariate density estimation, which are some of the curriculum are not considered as one of the non-parametric approaches. Okay, cool. But in FRM part 1, you have to consider it as one of the non-parametric approach. Clear? We'll deep dive into each approaches one by one. Clear? So what is the story of today's session moving forward? So that is what is written: dental normal method, analytical method, historical method, Monte Carlo simulation method, and multivariate density estimation method. Next. So we'll start with analytical VAR, also called as delta normal VAR. So put on the heading analytical VAR slash, also called as AKA delta normal VAR. I specifically used AKA so you don't confuse it as two different methods. It's same, only the name is different. Written? Okay. So what we have to assume in analytical VAR. If you're not listening till now, please start listening to the session now. What we have assumed, or what is the assumption? Yes, correct. We have to assume that the asset returns are normally distributed. That's it. Completed. We don't have to do any other discussion. No, actually not. Now, there are slides given to this, multiple slides for analytical VAR. But it is like two-liner discussion for you all, because you know normal distribution. We studied like normal distribution for 3, 4 hours, right? Invested most of the time on normal distribution. And if you have watched hypothesis sessions, then again we discussed normal distribution. Now think and tell me, if this is my asset returns, if this is my asset return, when I say asset return, there would be losses and gain both. If you plot it on the x-axis, in which section you will plot losses and in the which section you will plot gain, left or right? Where you will plot your losses? This section or this section, left or right? You will plot losses in the left and gain in the right. So you'll arrange your data. First, you'll talk about maximum loss. Then you will keep on reducing the loss. Somewhere the loss would be zero. And then there would be gain. And then you'll talk about the what is the maximum gain. And then you will put a distribution that is normal distribution. That's what you will do. If I am saying you, I am 95%, please revisit the interpretation of war. Interpretation number one. I am 95% confident that max loss is dollar X. Whatever the max loss is, that's not the concern. Now tell me how much you will cover in this normal distribution and in which direction you will cover to reach to a 95% confidence level. How would you cover 95% in this distribution? Now it depends on from which direction you are actually looking. If you're looking from this direction, you'll start covering 95%, 0%, 1%, 2%, 3%, 4%, 5%. How much you will cover till the center? How much you will cover till the center? Correct, 50%. Why? Because it is a symmetric distribution. Normal distribution, T distributions are symmetric distribution. Then you will keep on covering, keep on covering, keep on covering, keep on covering. Oh, here I have reached 95%. Awesome. So the total area is 95%. So you'll stop here. You'll try to find what is the losses here. Assume this loss is $5 million. Now, if you look from this direction, and assume this is a wall. This is a wall. If you look from this direction, and if this is the wall, whether $5 million will look like a maximum loss or a minimum loss? Max. Because you cannot see beyond this wall. But if I change the vision, observation, if I change the observation, then 5 million would be the maximum loss or minimum loss. Right, because here the losses would be 100 million, 99 million, 98 million, so and so forth. So if you look from this direction, at this point you will have maximum loss. And the losses would be less, 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 less. And you cannot see beyond this wall, so your minimum loss is 5 million. So therefore, the second interpretation was what? I am 5% confident that minimum loss is $5 million. Now you understood that why the war interpretation has two interpretation, because they're looking from two different observation point. One person is looking from the right hand side, another person is looking from the left hand side. And because I talked about the observation, I just wanted to ask a very scientific question. It is not related to finance. It's not related to finance. Which experiment, just this is a question of physics, which experiment has told that the experiment result depends upon the observer, not on the experiment? That was the biggest change in the concept. Generally, we feel that the experiment doesn't change based on the observation. Very good. It is a double slit experiment. What was double slit experiment? It was the experiment that told to the world that the light can be particle or a wave depending upon what? Depending upon the person observation. And that gave birth to something called as which field? Today the computers are being made from that. Correct. Quantum physics. So this was the first experiment which told to the world that it depends upon the observer that what would be the result of the experiment. How many of you are aware of that double slit experiment? Anyone except Tejaswa? I know Tejaswa is. Okay, not aware. Okay, cool. So have a look. It's a very interesting experiment. The same way in war, what's happening? From left hand side, when you're looking, you find that it is the minimum loss. From the right hand side, if you look, it is the maximum loss. It depends upon the observer, the result of the experiment. Clear? Okay, what is the question? Yamradul, can you state the question? Can you write the question? Till Mridul is writing the. Okay, he has written. Okay, just a second. Yeah, Mridul.
Sir, in the starting of this topic, you mentioned that the maximum loss will be on the left side, and when we go more to the left, the loss will be maximum.
Hmm.
Then, uh, and now you are mentioning if we see from the left side, the loss will be minimum. Why are we seeing from the left side?
Why we should not look from the left side? Then that's the question.
I think I'm getting contradictory uh, situations here, so that's why I'm confusing.
So, what, even I haven't understood the confusion. So, is it that you're saying you should not be looking from the left side? But my question is why you should not look from the left side? See, if you want to understand anything, you have to look from different perspective. So we have to look from the right hand side and the left hand side. I never said that we should not be looking from any direction. There are two interpretation always. Did I mention that you should always be looking from the right hand side? Or did I mention that you have to look from the left hand side starting of the session?
But in the starting, you mentioned the more we go on the left, the loss will be maximum.
The loss will increase. The
Yes.
loss will increase. And that's true. The question is, in this scenario, will the losses not be more than $5 million? Yes or no? In any scenario in the world, will the losses will not be more than $5 million?
It can be.
It can be. It can be that it will wipe your complete asset, or it can be it will wipe your complete asset and you will end up in the debt. For example, if you enter as a call seller,
Yes, sir.
right? So the story is the losses could be infinite. Even the normal distribution is saying that the losses could be infinite. It doesn't say the losses could be finite. But what is happening there? The probability of those losses are huge or less? It's
Little
huge.
less.
Less. Now, you can say that I am not comfortable with 95% confident. because the losses could be more, right?
Right.
So you will say, now I will speak in the terms of 99% confidence. So if you say it with a 99% confidence, how much area you will cover? You will also cover this area,
Yes. More area on left.
more area, and you will say, now I am 99% confident that the losses would be $10 million. Now, now you want to be more conservative. I want to say with 99.99% confidence. So what will happen? Your losses will keep on increasing, right?
Yes.
So war is not saying that the losses cannot exceed. That's why he is saying the person who is stating the war, or you have to state that I'm 95% confident, not 100%. Why not 100%? Because nobody can state the losses with 100% confidence. So I'm just being a bit conservative here and saying with 90% confident that the maximum loss would be $5 million. But you also know that you cannot state with 100% confidence that the losses would be $5 million because you don't have the crystal ball to see the future or a time machine to see the future, whatever you feel right. Correct?
Yes. Sir.
Yes. So therefore, you're being conservative here and stating, hey, I have only 95% confidence to state my war. Okay. Now, this question also give rise to then what is the confidence level I should choose? Should I choose 95%? Should I choose 99%? Should I choose what? It's a very important point. Actually, I didn't want to introduce this at this point in time because this is actually even tougher for a finance veteran to answer. How would you answer whether you should go for 99% or 95% or 99%? How should you answer that? Very good. That depends upon, yes, both the answers are exactly right. It depends upon first the risk appetite of the person. Why anybody would be interested in knowing the maximum loss or minimum loss? Why? So such that he can hedge those risks. How he can hedge the risk? He can hedge the risk by keeping aside certain capital. And that is what is written in your Basel also. To understand how much risk I can digest easily. So, what is my appetite to digest the risk? Do I have the sufficient capital? And that's why if you write Basel in Google or ChatGPT, wherever, they talk about only capital, how much capital you need to keep. So, how much capital you need to keep? Actually, if you rephrase it, if I have 100 million capital, I have the appetite to hedge or control the losses less than 100 million. A capital, not investment, a capital that you should set aside. Your fixed deposit. Example is your fixed deposit. The second is it also depends upon the sample. When he was writing based on the sample, basically what he was trying to say, what Amit was trying to say is that it based on what is the market scenario right now. If I calculate all the market scenario right now and find that there is a high volatility in the market, then definitely standard deviation would be incorporated in this calculation. But I'm very risk averse right now because everybody is making losses. Let's talk about what is the maximum possible loss. So I'll increase my confidence level. Okay. In a normal scenario, okay, the losses is not going to be like 100 million, 200 million. The market is normal. There is no trade war. There is no stupidity in the market because of some XYZ precedent. So, okay, the market is normal. Let's talk about 90%. Oh, tariff is there because of some stupidity. Oh, let's increase it to 99%. Hope Mr. Trump is not watching my videos. Cool. Okay. Understood? Cool. So, This is the analytical war. You assume the portfolio return or asset return to be normally distributed. The losses are in the left direction and gain are in the right direction. Cool. What do you do now? Y- Can you calculate 95% confidence level at standard deviation of 2%? So what I'm saying, this is your portfolio return. Okay. And I'm saying this is normally distributed with a mean of 0 and the standard deviation of 2%. I've given standard deviation of 2%. And how I am saying the mean return is 0? How I am saying the mean return is 0? Look into the chart. This point is what? 0. This is the line which bisects the data into two equal half, and in normal distribution, mean median equal to mode, and that is the center, that is 0%. Don't forget about the properties of normal distribution. What you see here at the center, 0%. So the mean is 0%. What is standard deviation? 2%. Can you calculate 95% VAR? Can you? Tell me what is the 95% VAR? Okay, can you or not? Just yes or no. If no, then I will give the answer. Can you calculate? If not, then I'll calculate for you. Just say yes or no. No one can or cannot. Okay. What I need to do for 95%? What I need to do for 95%? I should cover 95% area? Yes or no? Now tell me, I just have to cover 195% area. If I have to cover 95% area, from which direction I should start, right or left? If I start from the left direction, please understand, I will enter into gain. But war is about what? Losses or gain. So in which direction I should start covering 95%? From right to left or left to right? Just tell me. Right to left or left to right? Correct. So I'll cover right to left. Let's cover right to left, everyone. If I cover till the center, I'll reach 50%. If I go beyond 60%, I'll stop somewhere where I will be able to cover this area. This area has to be 95% of the total area. Do I know or do I have a table where this area is mentioned? Am I aware of any table? Have you studied that table? Yes. What is the name of that table? What is the name of that table? Correct. Z table. So open your Z table. I'm not going to open for you. Try to cover 95% and give me that Z value which you studied in quantitative analysis session 3 part 2. What is that Z value? What is your Z value? Oh, no, no, you covered 95%. So if you covered 95%, so you have to look for 95% area in the tail. And if you look for the 95% area, you have to look for what is written here. There must be 1.9 written here and there would be something written here. What is written there? 95% would be written at the center of the table. Anyone? What is Z value? Can everyone verify? Is it 95%? At 95%, what is the value? I think I I have to check because I think the answers that you all giving are incorrect. So let me check. No, you all are correct. The answer is correct. The Z value is 1.645. You all are correct. So Z value is 1.645. If Z, what is the interpretation of Z? How many? What is the interpretation of Z? Please, fast. These are quantitative analysis session 2 only. Session 3 only. How many standard deviation we are away from the mean? So how many standard deviation? 1.645 standard deviation. What is the standard deviation? 2% from the mean. So you will write mean minus, because you're moving in the left direction, mean minus Z into sigma. Mean is 0. Z is how much? 1.645. Standard deviation 2%. What should I write? 1.645 into 2 is negative how much? 3.29%. 3 minus 3.29 or 3.29% is the maximum loss in your portfolio. Now, this 3.29, am I saying standard deviation? No, I'm saying 3.29% loss. Can I calculate the loss in dollars? Yes. You have to just multiply the percentage with the dollar value. Say 100 million is the value of the portfolio. So 3.29 million is my war. Now what is the interpretation? I am 95% confident that the maximum loss in a year is 3.29 million. What is the second interpretation? What is the second interpretation? I am 5% confident that the minimum loss is going to be 3.29 million only. Minimum loss. Clear? So that is what given here. You covered 95%, or you can say I have covered only 5%. Whatever you want to say. You'll reach at what? 3.29% negative. That's it. Whether you observe from this direction, whether you observe from this direction, your war number is going to be fixed 3.29. The observation is going to change the interpretation. If you see from the right hand direction, you say that is the maximum loss. If you see from the left direction, you say the minimum loss. If you see from this direction, you say I'm 95% confident. If you see from this direction, you say 5% confidence because there is a wall. You can't see beyond the wall from whichever direction you see. And that wall is war. Is the story clear, everyone? Okay. So again, please calculate for 99% and the portfolio value is 100 million and give me the two interpretation of war. Almost same question. You have 1 minute. Okay. So what will change in this? The only thing that will change is you will cover not 95%. How much you will cover? Yes, that is correct. Because it's impossible to. calculate any measure of risk without standard deviation. You're only tweaking it for everyone to understand. Now you'll cover 99%. If you cover 99%, what is the Z score you will reach? What is the Z score at 99%? Correct. At 99%, even I'm checking. 99%. Yes. It is 2.33. Correct, Prasanna. 2.33. So 2.33 is Z score. What I have to do, right? What I have to write now? Nu minus Z into sigma. What is mu? 0. What is Z? 2.33. What is standard deviation? 2. 4.66% or 4.65%. Got it? Easy? Perfect. Now, this one is slightly tough. Slightly tough. It is actually testing your understanding of quantitative analysis session 1 and also portfolio management session 2. We discussed a very small concept there in both the session. A portfolio is worth 100 million. The daily standard deviation of the portfolio return is estimated to at 1.8% and the mean daily return is assumed to be 0. Calculate the 1 day and actually don't assume to be 0. Let's assume it to be 0.01. Now, very, very important information that I want to tell. In all the FRM or CFA curriculum, most of the time, they will not give you mean daily return in the calculation. But if you see, then you need mu minus z into sigma in the calculation of VAR. You need mean, you need standard deviation. And they will not mention anything about mean daily return. They will not give you mean daily return. The reason is across the planet, across a different financial firm. I'm not talking about any one of the firm. Across every firm, whoever generate the VAR number, daily VAR number, whichever firm, whichever model, they assume any firm across the planet, they assume the mean daily return to be 0. So if there is a firm XYZ giving you a VAR number, daily VAR number, in their model, the assumption is the mean daily return is 0. Everyone follow this. Okay. So therefore, most of the time in the question also in FRM GARP questions in the examination, they do not mention you mean daily return. Okay. Now you have to calculate 1 day 95% VAR and then you have to calculate 1 year 95% VAR. Can you do this calculation? Please be fast. I'm expecting answer in like 60 second, 1 minute. It is very easy. The first question is super simple. Maybe second it will take time. If you're not still not able to answer the question, then please ask question. What is your doubt? Fast. Anyone? It's more than 1 minute. What's happening? Is the concept not clear? Solution for question number A. How you calculate what? At least give me the formula to calculate the war. What is the formula to calculate the war? Mu minus z into sigma. So what is mean? Mean, what is the mean value given? Correct. Mean value is 0.01. What is Z score at 95%? 1.645 into what? Standard deviation, that is 1.8. 0.01 into 1.645 into 1.8. Sorry. What this is coming as? What is this coming as? Negative 2.961.001. So this is 0, sorry. This is 2.951 negative. This is in percentage. Now, most important, this would be one of the answer given in the examination, 2.91% war. The second would be given $2.951, which is the correct answer. Always remember that war is always written in dollars term. So what you'll do into 100 million, which is the portfolio value mentioned. Okay. Hmm. Now this was easy question. Super easy. Can anyone solve question number B? Solve question B. You have to calculate 1 year war. Do we have 1 year mean return given? Do we have 1 year standard deviation given? Yes or no? Is it mentioned? Check. Do we have? It all says daily, daily, daily. Daily standard deviation, daily mean return. Then how would you get the 1 year mean return and 1 year standard deviation? How can we get it? Okay. So into 12 analyzed. This is, are you saying for mean or you are saying for standard deviation? This is question number one. The question number two, from daily to year, you multiply 12 or you multiply 365 or what? Or do you multiply? Good. And I got one answer that says square root of 252. But do you divide or do you multiply? That is the right answer. But do you divide in this case or multiply in this case? Okay. So if 1 day return, now if you don't remember, I'm reiterating for you all. If the 1 day return is 2%, then the return is okay to write 2 into 2%, because in 1 day you will, 1 day you will do earn 2%, in 2 day you will earn 2% and then 2%. That's fine. In 3 day you will earn 3 into 2%. In 4 day you will earn 4 into 2%, so on and so forth. So when you're talking about a daily and you want to move to monthly or yearly, you multiply directly with time. That is okay, that's fine. But you cannot do this with standard deviation. In the standard deviation, if 1 day standard deviation is 3%, then 2 day standard deviation would be, do you remember the discussion? The 2 day standard deviation would be 3 into square root of time. 3 day standard deviation is going to be square root of time. 4 day standard deviation would be square root of time. How we got this? Do you remember what was the derivation? Anyone? This came from something which is called as, we derived it in quantitative analysis session 1 itself. Or if not session 1, then session 3 definitely. Otherwise, we could not discuss normal distribution. This came through what? This came through the assumption of IID variable, independent and identical. How? If 1 day standard deviation is sigma 1, then 2 day standard deviation must be sigma 1 square plus sigma second day standard deviation plus 2 into correlation of sigma 1 and sigma 2 under root then. But the problem is, I'm assuming that standard deviation is what? Identical. So sigma 1 must be equal to sigma 2. So 2 day standard deviation, if I say sigma 1 square, then it should be also sigma 1 square plus 2 into correlation of sigma 1 and sigma 2. Basically sigma 1 itself. Then I'm saying identical and independent. When I say independent, then I'm saying the first day standard deviation must be independent to second day standard deviation. So this correlation becomes 0. So sigma 2 is equal to sigma of 2 days, not sigma of second day. Sigma of 2 days equal to sigma 1 square plus sigma 1 square plus 0. So sigma 1 square into 2. So therefore 2 day standard deviation is root 2 of sigma 1. And for 3 day, you keep on increasing this equation. So always remember, even if you don't remember this, always remember that if you want to increase the standard deviation, you increase with the square root of time. You don't increase by like with time, because here it makes sense. If 1 day you earn 2%, even if you assume IID, the next day you will earn 2%. What is 2% plus 2%? It is going to be 4%. And if you respect if you respect this, it would be greater than 2%. But loosely speaking, it will increase by time itself. So mean return will increase by time, but standard deviation never increases by time if you're assuming IID. If you're not assuming IID, you cannot even calculate. If you're not assuming IID, you cannot calculate standard deviation. You cannot calculate standard deviation because you cannot predict what is the standard deviation of the next day. Okay. So coming back to this question. So if the mean return of 1 day is given as 0.01, how will I got yearly return? I have to multiply 1 day with what? Time? What is the time? 1 day to 1 year. What is the time? 365. So I should write 365. But what is the problem? You have Diwali, Dasera, January, Saturday, Sunday. How many business working days you have? Correct. 252. So always remember, because you are not trading every day, even the asset manager is not trading every day. They're also enjoying their Saturdays and Sunday. Okay. So therefore it will come as 0.01 into 252. What about standard deviation? Standard deviation is coming as 1.8%. So 1.8% into what? Square root of time. Because from 1 day you have to move to 1 year. So 1.8% into square root of what? 252. You have to respect Saturday, Sunday, and all the holidays, national holidays. So on an average, 252. What it is coming as? 1.8 into 252 square root. What it is coming as? Faster. So this is 2.52% and this is 2 this is 28.57%. Now you can do mu minus z into sigma for 1 year because you have 1 year mu and 1 year standard deviation. So 1 year mean came to what? 2.52 minus z, that is 1.645 into 28.57. Calculate. So the final value is coming as 2.52 minus what? What is the final value? It also came as percentage, right? 0.01 percentage. 1.8 was percentage. It's all in percentage. So it's not decimal. It's not in bips. It is percentage. Hmm. Okay, so it is coming as minus 44.47%. And that is correct. Your losses should be so high in a year. The daily war. Earlier, what was war coming as? Can you give me the number? It was 2 point. What was the number? Earlier we calculated 2.951 million. Sorry. Yeah, it was 2.951 million in a day. So definitely it cannot be less than 2.95 million. But it cannot be also 2.95 million into 252 because mean is being calculated into 252 and the standard deviation is calculated by square root of 252. So it is not going to rise exponentially by the multiplication of 252 because mean is increasing with a multiplication of 252 and the standard deviation is not increasing with under root of 250 with 252 but under root of 252. So this will come as 44.47% into 100 million, that is $44.47. So at a 95% confidence level, 50% of your portfolio will be wiped off in a year. So that risky is your portfolio. So you need to reduce the risk. I'm not talking about the interpretation because we talked about it. I'm 95% confident that the maximum loss is 44.47 million in a year. And I'm 5% confident that this is the minimum loss in a year. Okay. So let's write down the steps for the analytical war. Because analytical war has to be always calculated in the terms of value, not percentage. So first identify your portfolio value. If nothing is mentioned, estimate the daily mean return to be zero. And if anything is not mentioned, even yearly mean return you assume to be zero. If nothing is mentioned. Calculate the standard deviation of return. Now assume the returns are given, but the standard deviation is not mentioned. So what you'll do? You calculate. You all can see the screen, right? Calculate the standard deviation. Then if you have given mean and if you have given standard deviation for a day or a year, try to scale up or scale down. If you have to scale up, multiply with time mean and multiply with square root of time standard deviation. If you have to scale down, for example, 1 year standard deviation is given. To calculate 1 day standard deviation, what you do? Scale down. If 1 year mean is given, so what you do? You divide by time to find daily. or monthly? ठीक है? So scale the volatility and scale the time, as in scale the mean return. If the mean return is mentioned, generally it won't be mentioned in your examination. Sometime they give mean return. Apply the formula z into standard deviation into square root of time into value. Actually, the formula is what? Mu into t. The true formula is mu into t minus z into sigma into root t. This is the formula. This is the final formula for what? For war. Into the portfolio value. Or the other formula, if you have to scale down, it would be mu upon t minus z into sigma upon root t into portfolio value. This is the complete war formula. Clear? So we have completed analytical war. Okay? So we'll take a 15-minute break and we'll enter into non-parametric approaches, that is historical war and Monte Carlo simulation war and MDE. Now all the approaches are now simple. Even analytical war was simple, but now to understand the war, it is very easy, very straightforward. So we'll meet after 15 minutes at 3. Okay. And we'll start with non-parametric approaches, that is historical simulation war. Okay.